thank you everybody for joining for this training. It was not very, very long notice, but you managed to get time to have this conversation together. As we said in our invitation letter, this is basically to touch base and have a conversation about financial reporting and accounting. And based on the current trends, what we are seeing around funding and expectations of CARTA based on how the funders are treating these reports. And again, a bit of what might have happened during the audit of our APHRC last year. And some of this we will be able to be looking through to see what is the best way to have these reports done the best way possible. We're going to have this discussion together. It's not like everyone who is going to be here who belongs to CARTA. We might have people who are not necessarily partners, CARTA partners, but we have to have this conversation together. It will be interactive, as Hannah has said, and welcome to be free to say or ask whatever you want to ask. Thank you very much for joining this conversation. This conversation will be recorded and we will actually post it at some point in our website for review. In case you want to do that, we might need to break it into sessions, but it will be a recorded session. Thank you very much and welcome.
Thank you, Kavins. I see a number of participants have joined us as we've proceeded. So quickly, we'll go to the first presentation by Duncan. Duncan, the floor is yours.
Thanks, Anne. Let me put up my slides. Good morning, everyone. I believe I met some of you. So great to meet you here. So, and let me know when my presentation comes up.
It's up, so it's not on presentation mode, but you can see it.
So, okay, thanks. How is it now?
This is okay now. Please proceed.
Okay, thank you. So, yeah, I'm covering project cost tracking and variances. And I would like to start by saying I'm aware this is something that you are familiar with to a great extent. And as we go through this together, I believe there's some learning that you're going to make to get from one another, even when we get into the question and answers and as we also engage with my presentation. So be free to stop me at any point so that we can engage deeper in an area that you'd be interested in. So I would like to just speak about some prerequisites when you're talking about project cost tracking and variances. It means there is a reference point that we are using to track the costs. So what are these prerequisites? One, for effective project variance analysis, the expenditure analysis, you need to have an activity-based budget. There are other forms of budgets, including like the commonly used historical budget. But this activity-based budget as one of the best budgeting method because of the value that it brings in that it makes you think about all the activities that you've been involved in and value them, as opposed to, say, like historical, you were saying last year we spent $1 million, this year can we add 10%? Should there be a need to like compare? You'll have to go to last year's items to make sense of the current year's items. But activity-based budget, you start from zero and build up the activities and value them. When it comes to comparison, it becomes easy because you'll be looking at what did we do and vis-a-vis what did we think about when you are coming up with a budget. So maybe to just say an activity-based budget needs to be as comprehensive as possible. It needs to be competitive, need to be efficient. I'll get into an example of that so that we see exactly what we're talking about. The other thing is you need a good financial system. The budget by itself needs to be able to compare with the actuals. So there should be a system that will capture the actuals and relate them to the budget. There are many off-shelf systems. I've just listed a few here that I may have engaged with one time or another. These MS Dynamics, 65, QuickBooks, Sage, Sun Systems, name them. And we need one that is sound for control purposes. Most of them are good. I think we may need some tweaks here and there because of the different natures of how institutions have been configured, but they play the same thing. I look at them like vehicles. They can equally give you the service you need, whether it's a Toyota, a Nissan, a Mercedes-Benz. Yeah, but there are additional things that may come with the cars, as the same way as these systems. Some may be taking you further, but you get the basic thing. You get a system that will be able to give you a comparison, record your transactions. And of course, we prefer a system-based financial system as opposed to a manual or simple manipulatable worksheet-based system. So those ones should be avoided. I know with your experience, you can actually do accounts with Excel. You can even do manual. Some of us found manual systems when we began working, and I know even governments still use them. So, and the reason is because they're prone to abuse and errors and those mistakes. With advancement of technology, there are many other things that you get from a good system, including level of accuracy, better audit trail, you have inbuilt controls, and speed. So it becomes easy for you to, should there be any change, one can see where the change happened, who did the change, were there approvals. It can give more comfort for auditors. As a prerequisite is a project team and ownership for you to compare expenditure and the budget. There should be people who own the project, the grant, so that they're able to safeguard the resources and ensure that only what is meant for that project is paid for. Of course, it has a project structure. And here I would like to highlight the importance of the PI and project manager. I tell my team at APHRC that when you are the PI or the project manager, you're essentially the CEO. Any person working on that project should respect your position. Actually, with the donors, should there be a problem, you'll be the one who will be accountable because your signature is on that contract. So if you are a PI, I think take that seriously. If you are a team in the grant, respect the position of the project manager. Somebody may be positioned higher than the project manager in an organization, but even them should have a level of respect for the project manager's role in the grant, not to force things, and that includes all the way to the CEO. They should come in to support the performance of that project. Forum for review, and it's also a forum for review. There should be a forum for review and discussions, and this needs to be set up and be clear that you have monthly project meetings. You have so that you're able to review performance against budget. It should include this review as an agenda item. Let it not be an A or B, because there are, when you look at A or Bs, maybe you'll be constrained on time. It may not be given as much attention as it should. It may not be, people may not prepare for it in advance. But when it's an agenda item, you could have you could share it early in time before the meeting, and people would engage with it, so that when you get into the meeting, you have a fruitful discussion. The oversight should be beyond project team. Yes, I said the project manager or the PI is the CEO of the grant, but they also fall under a governance structure. So their work should also be overseen by their higher management level. At TPHS, we have the senior management team that meets every quarter to review all the performance of all projects, and they're able to get insight from that higher level. Also seek to understand, all should seek to understand the budget monitoring. It shouldn't be left to the accountant. You should push the team to understand this. If you have to call for a meeting or a training to do this, at APHS we do project management training every year, especially for non-financial staff. They need to understand this, because if they don't, then all the burden is left on you, and you also not get value from them, because we'll be taking this accounting wing to be not their font, and that will be a disadvantage to you. Also, we have to have a work plan that will help you do a good variance analysis, because some items may already have been like planned to have been done, and they've not been done. So that gives you more information of why the performance on spending is the way it is. Some items may be waiting towards may be requiring maybe the end of the project period to be done. Then if you have a 0% spending, then it makes sense. Then it should be based on a duly executed contract with a donor. In this industry, it's possible for you to start spending, maybe because of promises of a meeting or an email, and then later on issues arise, and the foundation that should support your involvement in the grant then is not there if a contract has not been duly executed. And also the contract will build into many other things that the review we need to borrow from. For example, if you're looking at the timings of activities, that those may be presented in a work plan in the contract. If you're looking at moving funds between lines, the contract may already have allowed you to do that. But if you don't have a contract, what would be your support when you are moving figures around? Then the other thing I wanted to talk about is the purpose for project cost tracking and variances. Specifically, we want to check on over and underspending and taking corrective action based on the circumstances. It also helps in identification of errors in posting. You may not be overspending or underspending. It may be that maybe your expenditures are somewhere else, or there've been errors, and another grant is posting the expenditure into your grant. So by reviewing expenditure against budget, that will bring out this, engage the team, actually have them look at the detailed report and ask them, are we missing anything? Is there anything in this report that should not be there. That will help you realize that get the correct position rather than over or under reporting by error. It also gives you an opportunity to get value addition contribution by the team. When you have those comments on why you are underspending or underspending, that gives you an opportunity to get their insights concerning that. There may be information that you don't know. You are thinking you are doing really badly, but by engaging them, you actually realize everything is okay. But you need that forum, that activity of tracking for those insights to be given to you. Otherwise, how would they engage if you're not showing them what you have? It also facilitates urgent decision making. And this is something that you really need to take to prioritize. I've seen situations where a project is coming to an end and there was an equipment that needed to be bought to support the grant. For example, it's a 3-year contract and there are laptops to be bought, and you're buying laptops in the second half of that year. If I don't ask you, okay, why are you buying it now? You've already finished maybe 70% of the time and you're buying it now. You can't really justify that. So look at those things. At APHS, we try to look at these things very quickly. Is there an equipment to be purchased, like a laptop, buy it SAP as the project is beginning? Also things to do with fund movement between lines. You don't wait until it's too late. You may not even be able to utilize those funds in case there's a good reason to move them, but you are doing it when you should be reporting the final report. Also, donors, some donors may not have a problem with you investing idle cash if funds have been given to you in advance. There are opportunities to earn interest in a current account, for example. You can convert money in advance. You get, say, you can invest money in short term, like fixed deposits. It's possible for you to even place them for a month. If a donor has no problem with you making that extra money, if it's 10,000, 10 million, for example, and you're getting an interest of about 10%, I'm talking about maybe the local currency. By the end of the month, there is some interest there, some extra earning. But again, look at the contract. What does it say about such? Look at also the work plan. You don't want to find yourself in a situation where you're saying you can't implement because money is in a fixed deposit that cannot be liquidated. And banks also have even the opportunities to keep money and get it when you need it. You may not place it for a month, but you may make it accessible when you need it. Then the other thing is it aids future planning. What you learn from the variance analysis, you notice that maybe you've been budgeting poorly on travel, on training and such. So in the future, you have a basis of making your budgets even more appropriate for the work that you're doing. Then it also helps you keep sight of deliverables. You need to marry how you're spending and how you are delivering. You may be very good in spending. Everything is on schedule. But when you look at the program team, maybe that staff time that you're charging has not contributed to what needs to be done. And it becomes a problem later on when you are reporting to the donor. There's a narrative does not speak to the finances. So ask the right questions. Listen to what the program teams are saying about the project. If you find things like there've been delays here, look at your figures. Your figures showing delays. there's a hindrance here, maybe they've not got some government permission, then why are we spending money here when the permissions have not been given? So those things should be the content and what the program teams shares should speak to your figures. How you'd rather be attentive to what they are saying at the time they are saying it than looking at the report much later and seeing that you need to make corrective entries. Yeah. Then the other thing is, I mentioned I want to speak about an activity-based budgeting. These are things that you are familiar with. Yeah, it doesn't harm to look at a simple example. Staff costs. I just took two examples: staff cost and field work costs. It can be many other things. Can be equipment. Can be construction work and all that. But looking at this, you will see. Maybe if I pick one line like the senior research scientist, you're saying you've done an analysis and you realize you will need three days. That works out to 1% of his annual time, and you're paying him $150 per day. That works up to $450 for the year. I've done that for year 2. You notice I've also inflated the figure by the inflation adjustment. It's the same LOE, but the figure has gone up to 473 from 450. And for year 3, again, using the same inflation adjustment, it goes to 496, and then up the total here. Now, when it comes to analyzing the cost, you'll be looking at, did this senior research scientist spend 3 days? So you spent 10 days, for example, you need to justify or explain that. Sometimes it might be too late to do that where the donor is concerned. Maybe you should have already sought that permission to spend. But when you're doing a regular monitoring, like a monthly kind of review, it's possible for you to see this person has already exhausted their time before they go to 10 days. What other communication do you need with the donor, or what internal changes are possible? For example, you might realize this person who needs 50 days can sacrifice 10 days, which may be, the rate may be different, but maybe what this person needs to do in 10 days, this one can do in 5 days. And you make those adjustments internally as long as they are within the confines of the agreement with the donor. Because most donors may be looking at the total year, 15,000, not necessarily the line items. But whatever you do should add value, should be able to result in implementation of the project, not again explaining why you did not implement because you used a different kind of staff who could not do what was required. No, it should be someone who's capable. Then when you go to other kind of costs, this is direct personnel costs and this is direct other costs. The same thinking, number of days, level of effort, the rate, and the amount. Now here I'm saying training meals for 2 facilitators and 30 field workers for 5 days. So when you implement and then it ends up being 6 days, what does that mean? Or when they're sending you an implementation budget before they go to the field, you can look against this and tell them, okay, we budgeted for 32 field workers for 5 days at the rate of 15. Can you make sure that whatever you think come up with still does not give us more than we work within the $2,400? That's possible because you're using an activity-based budgeting. If you had just put 2,400 here, it has its limitation. In case they end up spending 4,000, you can't know how to question them. What went wrong? It may be that they would question why you put it 2,400 and say you are the one who did put the wrong figure. You should have put 4,000. But when you ask them to think through these activities, then it is up to them to make sure that they think right, as reasonable as possible, and then the implementation becomes easier. Then value for money. When you're doing this activity-based budgeting and implementing the projects, this is something that should always be at the center of your thinking and doing. It's an issue about getting items as competitive as possible. It's about sourcing early to avoid last-minute high prices. This is especially significant with travel. Plan well to improve efficiencies. Don't do things last minute again. Benefits should exceed costs. It's not necessarily that you go for the cheapest and all that. Or sometimes you look at the benefits that exceeding costs, especially for items that are not standard, where quality becomes and other measures become important. Quality consideration should be put in mind. Delivery time, yes, may be the cheapest or the highest quality, but it will be delivered next year and you need it now. So again, your decision should look at those things. Reliability, past experience, all this built into how you work. The decision you make about budgeting and the decision you make about variance analysis. Yeah, your past experience may tell you a suggested way forward may not work. Then I have a typical example here, and here I want your contribution. I have a simple report. It's I've not indicated the activity, but it requires personnel time, it requires some meeting costs, and there's an overhead. So this was the initial budget as shared with the donor. And here is the spending to date. To date, I'm calling it 31st December. We may not have reached there, but assume it's up to that date. I have the variance in dollars and I have the variance in percentage. And then there's a comment column. I would like maybe by...
Can you please go back to the previous slide? Yes.
Yes, this one. Yes. You have a question?
I was just...
Sorry, Peter. Let me go back. This sorry. This one. Yes. Yes, Peter.
Okay. Okay. No, okay. It's okay. I was just reading something. Now it's okay now. Thank you. Proceed.
Yeah. The point is that despite all the level of spending, this should always guide our decisions. Yeah, I wanted to get your contribution on this. How are we doing? And here I'm looking at timeline. There could be other things, but I'm looking at the timeline as one of the measures. If you are the donor and you're looking at this, what kind of questions would you be asking? Any person can raise up their hand and contribute. And if you see any hand, you can allow them to speak. Okay, Charles.
According to the presentation, on program accountant, it seems there is no spending and it's 100% unspent. What does it mean? How can that be explained to the funders that are we saying we didn't have the accountant, or maybe something is wrong? Because I think for this table to be made, that means there was an accountant and the spending is zero. Can we say that this report is correct? Thank you.
Yeah, thanks, Charles. That's an important observation. The financial report is even being shared. Who is sharing it? Does that mean that they are not charging their time, or somebody else who's not an accountant did it? And if the accountant is the one who's doing this and they've not charged their time, how can we be sure that the others are charging their time right? Maybe this time is even for other projects. So there are certain questions that would arise from a reviewer, not necessarily a donor, even the project manager, looking at the report like this presented to them in a project meeting. Any other comment?
Yes,
Yes, Peter.
yeah, I can see there's confusion between the budget and the expenditure. Instead, the budget is for 1st January 23 to the 1st December 2025, and the expenditure is 1st January to 23 to 1st December 2024. It looks like expenditure is for 1 year and budget is for 2 years. While I think it should be 1 year by 1 year.
Yeah, Peter, thanks for that comment. The report is comparing five. What they are reporting is to third. That's 2023 and 2024, which is okay still. In terms of when you're making comments, you have to make comments at that level. That I'm looking at 2 years performance against a 3-year budget. Again, it also depends on how the donor has set it up. Some donors want to see cumulative, some donors want to see the annual budgets. Yeah. Those are comments that should come from project manager also. Why are we looking at cumulative and not maybe the annual plans? So go back and prepare for us a report that shows just 2024. Let's have the 2023 separate, 2024 we began and up to date. So thanks, Peter, for that. There is more value to annual comparison. Any other comment? If you've raised your hand,
We
you
have a
can.
comment in the chat.
Okay. The
Cliffy
overhead
said,
variance is more than 10%, which is too high. So the variance is 20%. We have 6,000, we spent 5,000, remaining 1,200. I think for the overhead, it moves together with, it's a percentage. So you see this is 10% of 62,800, it's 10% of 50. So it's informed more by the lines that are up here. Yeah, you don't spend anything, you charge nothing. You spend everything, you charge everything. Any other question? Comment? You can actually just speak. I'm seeing our team is small. We are 19 people, 18. Any other comments? Before I move on. Yes, Robert.
Yes, good morning. Thank you again.
Thank you, Robert.
I had a concern that has to do with if, for example, the budget was intended for 5 months, and then I have to complete the activities before the 5 months. Does that have anything negative on the budget or on my reporting? Thank you.
Yeah, that's a very important comment. In that, if you do work faster, and based on the nature of the project is okay, then there's no problem. But if the project needs to happen continually for 3 years, or the 5 months example you've given, say like you have to pay someone for 5 months, but they finish the work in 3 months, what does it mean for the 2 months? Maybe you had given them a contract for 5 months. Do you lay them off? What do you do? Do you get them other work? Yeah, so it's important to match to see that the budget actually covers the period that the donor is comfortable with. I don't see a problem with finishing the contract early. You just have to, as you are doing your monthly reports, you could have come up with ways to deal with the staffing issue beyond the period, in case they're able to finish the work quickly. Now, this is a multi-year project. In that line of your question, I'm seeing you spent 80% in 2 years, and we are remaining 20% for the third year. If the project was happening continually at the same, like it's a steady kind of a project, I would have expected us to be at 67%. So what does that mean? That we are spending, are we spending too fast? What would happen in the third year, 2025, if we find ourselves short of money? Yeah, those are questions that the project manager should ask based on the work plan. I can see there's a comment in the chat. The research officer's time has a variance of 29%. In most cases, the acceptable variance is 10 to 15. Was prior approval sought from the funder to exceed? Yeah, great comment concerning that. Yeah, this person seems to already have exhausted their contract, their funding. It may be that maybe when we were recruiting, we got the research officer, the project manager left. The research officer is doing more of what the project manager is doing. So some of them may be explainable, but again, those are the questions should be raised. So you are actually exactly doing what project managers should do and the project team concerning these numbers. Another thing I can say about this, so that we can move on, is the part of program admin also has already exhausted their budget. What does that mean? We have the project manager also. There is a comment here that it's okay. What does okay mean? Because it should not be at 50%, it should be at 67% if it's constant. If it's 49, it's okay. The accountant may need to explain that maybe much of the addition, half of the work by this person needs to happen in 2025. So we are okay having spent half at this particular point. That would be okay. There is also these meeting costs. We seem to have already spent on conference package and accommodation, but no air tickets were purchased. So there's a savings here of 1,700. Would it be possible to utilize this money in other budget lines? Because, the meeting has already happened, meaning these air tickets may not be necessary after this. Yeah. Do we need to seek donors' permission because this is a different budget line from personnel? Someone mentioned there that they allow 10 to 15. It means if you are to move this, it might go beyond 15%. So maybe donor permission will be required. There are so many other comments you can get from this. But I just wanted us to get a feel of how the exercise should happen. I think I'm almost done. So in summary, let's have a system for sharing with the project on the spending. Let's regularly monitor key elements of expenditure, staff time, field or lab work, compare with the progress on deliverables, so that you're not spending and work is not happening. Make sure the two are in tandem. Note cost savings and plan for them. Don't wait for the end of the project for you to run to the donor and say, oh, you made some money here. We've saved some money here. What do we do with it? It's also a problem for the donor because they also need to report to their management they may be seen to have given you more money than you needed. So your success in like the target is, can you do the work within the money that you've been given, so that if you need to add value, maybe you are thought of having a meeting of 20 people. Now that you have made savings, 25 can attend. Yeah, that helps you and also helps the learner. And another thing about this cost savings, you realize you can't get the overheads before you spend. So by you not spending as you had planned means you may have budgeted for overheads that you cannot receive. Then building trust, yeah, requests for approvals were necessary. I think someone mentioned that in the chat. Is there another question on the chat? Oh yeah, somebody actually mentioned about the issue of the air ticket. That is Oliver. Thanks. Then meet project targets within the budget. You don't want to go back to the donor because you didn't anticipate cost, or you did not plan appropriately, or you did not think through what is required. Avoid underspending. We'll also look at vis-a-vis the deliverables. Maybe I should say something about this underspending. I worked with I can say over 200 donors, and I've worked in NGO for 22 years. One thing I've noticed with donors is that the decision, the money they give you actually reflects on them also, whether they did a good assessment or not. So what situation where you saved money and you tell the donor, we made these savings, and the donor is asking you questions like, what do you want me to do with this money? So you get the point, like that the donor trusted your planning and expected that you spend to the last dollar. Especially with non-government donors. With government donors, if they make any saving, they want the money back. Actually, most of them will not pay you even in advance. But for donors, for foundations, they want to work with you to spend to the last dollar. Because if you're returning money, that project manager may be questioned, why did you give them more money than they needed? Seems like you didn't do a good assessment. So you find the donor is as equally interested in you utilizing the funding as agreed on the contract. The best thing you can do to help your donor or the project officer is to make your budget as reasonable as possible. So you're asking them for $100,000. That's what you need. Don't ask for $100,000 and then you go back and say, 50 would have done. Or you ask for $100,000 and you needed 150. Then this donor will find himself involved in a project that he can be questioned about. Why did you give them? It looks like you didn't do a good assessment. These people needed more money than what you gave them. And because of that, this project is failing. So the best help, make sure you give them a reasonable budget that you not have a problem spending, and you not have a problem, you not have a problem spending, and you not also need run into a deficit. Report must be complete and accurate. Make time to prepare the donor reports. Don't do it on the last day. You may need signatures, and the people signing may be on leave because you didn't prepare well, and then you end up being late in sending the reports. And these ones, the way we report has a time stamp, because most of the times we report by email. So the auditors will want to see the email that was sent to the donor. When was it? And then it's clear that you are late or not. Spend capital expenditure early. I said that. Monitor donor by donor expenditure. This is where a donor is funding a program. Some may want their money isolated, so not in a pool. Those who don't mind a pool fund spending, that's fine. But the ones who require to see where the exact dollars went. You need to monitor donor by donor spending. Keep clear contracts files and budget notes. This will help you in the assessment, and donors don't like surprises. Inform them, engage them as you move on. That's the end of my presentation. Any additional question or answers? I hope you're doing well on time, Anne.
Almost. I had asked you to wrap up, but I think we are supposed to be in the Q&A session, and some of these have been. We've engaged in Q&A as we've proceeded, but yeah, right on schedule for Q&A. So if you have any questions generally about the presentation or some additional comments you'd want to raise, this is the time. Feel free to raise your hand or put your question in the chat.
There's a question here about how do you switch funds from one budget line to another. Most donors don't have a problem with items that any movement that's less than 10%, because it's unlikely that you're going to spend money at 100% for every budget line. Like staff time, it was $10,000, you spend $10,000. So they give you that 10%. I've not met a donor who would have a problem with that. Some may not want you to move beyond the 10%, the 100%, especially for staff time. But majority of donors will allow you to that flexibility. Should you go beyond 10%? Some go up to 15%. Look at the contract. What does the contract say? But anything beyond 15%, you definitely need to write to them and tell them. And the answers are usually positive if you have a good justification. I hope that answers George. And if you see any hand, you can let me know.
Yes, I want to put a question in the chat for the participants, just so we hear how the process is for you. Feel free to answer in the chat. As you do that, Akim's hand is raised. So please unmute and ask Duncan. For the rest, please look at the question and put it in the chat, or you can raise your hand after that. Akim?
Hello, good morning.
Good morning.
Hello.
Hello, we can hear you.
Good morning.
Good morning.
Okay, thank you. And thank you for the presentation. My question is, for the example given, we have some variants that are negative, and we have some that are also positive variants. Let's assume for those negative variants, we seek for the funder approval, probably to via some of the fund from the surplus area to the deficit area, and they refuse. The funder they refuse to move fund from the surplus to the deficit unit. What will happen? And then, like you mentioned, these activities have been done. The cost you have incurred is more than the amount, the actual cost incurred is more than the budgeted item based on the budget. So what will happen in this case? And eventually you talk with the funder, but they refuse those negative to fund the negative variance. What will happen in this case, sir? Thank you.
That's a good question. You are contractually obliged to keep within the confines of the contract. So if the contract tells you not to spend beyond, then the donor is justified to tell you they're not going to fund any amount beyond that. And in that case, you end up losing, because you ought to have stopped that spending. Spending takes time. If you are to have a meeting, you need to get a hotel, get rates, seek quotations, the approvals, sometimes you're going to a committee and such. So for you to spend, it means a deliberate decision that was made. that's a point where you need to check on the costing to see like if it's going to be an overspending. Seek donors' permission. That someone should flag that and say before they put their signature, I think we are going beyond the budget. Can we seek the donors' permission to make this change? And you see, now that's why it becomes very important for you to have frequent reports. Someone asked about how frequently should this monitoring happen. For me, I think the latest should be a monthly. And I'm saying latest because current systems allow you to do an online everyday kind of review. You can go to the system and see how you're doing. But if you must wait for a period, let it be monthly, because much can happen in a quarter that can end up costing you dearly. And in this era of technology, I don't think you can justify why you have to wait for 3 months to notice a problem. Yeah. I hope that answers the question that I saw in the chat about how frequent should this happen. Yeah, so the answer to your question is you may have to pay for that cost from elsewhere. Some donors require you to account and then they pay. So for them, it will be easier for the donor because they will not pay you that additional spending that you've had. If they paid you in advance, it might mean that if they were supposed to give you 100,000 and only 90,000 is within the budget lines, they may fail to give you the 10,000 because you exceeded some other areas. Yeah, over. But normally they want to help you. For them to do that, maybe you didn't give them good time to respond to help you. Yeah, because the success of the project is also their success. And if by not allowing you to spend more within the overall big budget, it's going to make the project not meet its deliverables, then objectives, then they also stand to lose. Over.
Thank you, Duncan. We'll have one more question from Peter, and then we can proceed to the next session. Peter?
Yeah, Peter can go on.
Yes, thank you very much for the presentation. So I have just one question on the issue.
We are losing you. I don't know that it's me.
Value for money.
No,
You mentioned that just we need. Hello?
Yes, Peter?
You're breaking. Yeah.
I'm breaking. Okay. Maybe should I repeat again? I said.
Go ahead, Peter.
So you mentioned that you need 3 codes for the purchase. So what if the 3 codes were not obtained? Should the purchase proceed, or maybe what steps should be taken before?
Peter, you're hardly audible. Maybe try again or put the question in the chat because you cannot hear you.
I'm thinking, Anne,
Yes.
you can put the question there. We can address it later, or I can answer it on the chat.
Yes, please, Peter,
To save on time.
yes, please put the question in the chat. So we're going to take a health break for about 5 minutes. So we'll begin the next session with Janet at 12:15. Please don't log off, just mute and stay on the call and take a few minutes to get a glass of water or a cup of coffee. And then we'll be back with Janet promptly at 12:15. Meanwhile, Duncan will be addressing the questions in the chat.
Thank you, Anne. And thank you, Duncan, for setting the pace for the training. Allow me to share my screen.
And Duncan, look at the chat. Some questions are still raised for you.
Yeah. So that's what you want to see. You want to know how much was advanced and how much they accounted for. Okay. Okay. Mhm. To put it on presentation mode. Thank you. I'm able to see my screen. Hello, can you hear me?
Yes, although it's not on presentation mode.
Okay. Still. And now?
On my side, not yet.
Okay, from my end it is.
Kavins, is it on presentation mode on your side?
No, it is not.
Yeah, not. You can click on that presentation knob. You can see it, the icon down there. Are you using two screens?
Yes.
You're using two screens?
Yes. So
Yeah,
let me
unplug the secondary
let me
screen.
remove that.
It normally affects.
Okay, so I'm on my laptop only now.
Yes, it's okay.
Okay, fine. I was on two screens. That's fine, thank you. And I'm going to do the revenue recognition, billing and reporting. I know Duncan has already done the payments tracking and has already touched on some of the areas that I was supposed to touch, which is financial reporting. So I'll just have a touch base on it a little bit so that we can be able to save time and be able to manage the time that we have. So my name is Janet Mora and I'm doing the presentation for today. And the outline of this presentation is we'll be able to see what is revenue and how is it recognized. What is billing and how is it recognized also. Value for money, I think Duncan has already discussed this. Financial reporting, and lastly, it is the reporting to funders and the consolidation of the financial reports. Revenue recognition, as I've indicated, we'll first be able to see what is revenue. And when we talk of revenue, something that is not working well. When we talk of revenue, revenue is the total amount of money received from carrying out the business operations. And this is as per the specific operations of the organization. I'm aware in the training we have teams from the university. The universities, we have maybe teams from research organizations or other organizations which are not the universities. And still within the universities, we have, we call them business centers. All centers, maybe we have the research center, research and innovation and all that. So depending on the operation or depending on the unit, so the revenue recognized from that specific unit or the operation that unit undertakes is what we refer as revenue in the organization. Revenue recognition is a generally accepted accounting principle that stipulates how and when revenue is to be recognized. So whenever you get the money, maybe the funds are deposited to the bank account, or there's a promise you'll be paid when you do this. So we have a contract signed, and you will be receiving a certain amount of funds. We have a way that we need to recognize that income or that funding, and that's what you're saying. Revenue recognition is a generally accepted accounting principle that stipulates how and when the revenue is to be recognized. In different organizations, in different institutions, there are rules and regulations guiding us on how we record and recognize the revenue. And this is usually outlined in the finance manual. So maybe different institution, depending on where you come from, I'm sure all of us, we have something that is guiding us on how we record and recognize our revenues, and that is indicated in our different finance manuals. So revenue recognition, we have two major ones that we know or we are aware of, but also I will be able to share a few that they're not commonly used, but they exist, so that we can be able to understand what they mean and what they refer to. But majorly on broad category, we have two ways of recognizing the revenue, and one of them is the accrual basis. Accrual basis, this is where a business records revenue when it has provided the goods or the services, or this is when you've earned the income or when you've earned the revenue. And this is what is used by most organizations. And when we come to organizations like APHRC, and maybe why it's important for us to have this training, from the different projects we have, we may have the CARTA program, we have the other programs within the center which we partner with. Most of us, or some of us partner with APHRC. We give out money, we disperse funds. Maybe we have received the funds, we've just received that money in our bank account, we've put it as deferred income. That's how we refer it, because we call it deferred income. That is the account where we record that income because we've not earned it. Earned it, it's like maybe we've spent it, or we have expenses that we've incurred, or we have been able to fulfill the grant or contract conditions that we've been given or we have signed with the funders. Once we've been able to execute that contract successfully, once we've been able to incur those expenses, then we talk of revenue. And it's only at that point that we can say, now this is funds to us, this is income to us, that we can be able to spend on maybe the different maybe activities or whatever that we wanted to do. And unless the activities have been carried out, unless maybe if it's a consultancy has been executed or a contract has been completed, then that income does not belong to the center. It does not belong to APHRC. It does not belong to the different institutions that we work in. So whenever we receive funds and maybe we end up delaying in the implementation of the activities, we have the work plan, as Duncan has already shared, but we are not following up with the work plan. We are not implementing the activities as indicated in the work plan. Then that income, it does not belong to us. It means it's money that we are hold in trust, maybe of the funder or whoever who has given us that money, until we are able to carry out the activities, until we implement the items, the activities we've indicated in the work plan. We cannot be able to earn, or we cannot be able to recognize that income in our books. So that's why it's very important. Whenever us as partners, we receive funds from us, APHRC, and we know we work with a budget. You share with us a budget which we approve. And once the budget is approved, we share the funds maybe in terms of installments. We disperse the funds in terms of installments or as per the agreed schedules. We do not recognize that funds as income to us. That money is still sitting in an account which await the execution of the activities. Once the activities are carried out and you account, that is the only point, that's the only time that we recognize that income. As long as we've sent you the funds and the activities have not been carried out within your institution, that money is not earned from our end. you've not accounted for it, that money still remains as like it's more of deferred income. If the funder comes today and says, okay, how much money are you still holding? How much money haven't you spent? And if they want us to refund the funds to them, then any money that we've sent to you, you've not accounted for, you've not reported to us as having been spent, then that money still belongs to the funder or whoever who gave us that money. That's why it's very crucial, and among the items that came out from our audit for 2023 as an institution is the issue of delayed accounting and delayed accounting from the partners. And what does that one mean? These activities are not implemented, and the institution cannot be able to earn or recognize that revenue in our books. So it's a very crucial point to understand that unless we spend, unless we implement the activities, unless we implement if it's a consultancy, then we cannot be able to earn, or we cannot record or recognize that as revenue in our books. It's very important to understand that. And that majorly relates to the accrual basis, where you only record or you recognize the income once the goods or services have been provided, or once we've been able to execute the requirements of the contract, or if it's a consultancy, we've been able to execute it and we have been able to report on it. If we do activities, we do not provide the records, we do not account for it, then that one will not be recognized in our books as income. So it's very important for us to understand this, even with our program teams, that we need to execute the activities as per schedule, and for us to be able to earn the income and be able to spend it, to use that money or that income on whatever else that it was meant to do. Another form of income recognition is the cash basis. And this is whereby it recognizes revenues when cash is received and expenses when they are paid. This method does not recognize accounts receivable or accounts payable to its customers, even if the business has not yet received the funds. So this one is once you see the money, once the cash or the funds exchange hands, then those institutions, they just record or recognize it as income. This is mostly used by small businesses. It's easier to manage so that you do not keep, okay, maybe you have a record of your creditors, you have a record of your debtors, you have a record of your students, you have a record of the services you provided as an institution and you have not been paid. That one is not done on a cash basis. Cash basis is once the hands have changed hands, that one is recognized as income or as revenue in the institutions. So maybe if we had time, or on the chart, you can indicate as in your institution which kind of revenue recognition method you use. We will review that, but we have majorly these two forms of revenue recognition, which is the accrual basis and also the cash basis. We have other forms of revenue recognition which are in place, but they're not mostly or majorly, they're not common. And these are like the point of sale method. We have the cost recovery method, installment method, completed contract method, and percentage of completion method. But these ones, if you find in one way or the other, they will be either in the accrual basis form or it is under the cash revenue recognition form. So, but when they're broken down into this, maybe different small institutions may be referring to this one of these, but in the broad category, they either belong to the accrual basis or to the cash income recognition basis. So in a quick way, what does each of them mean? When we talk of the point of sale method, this method recognizes revenue at the time of sale. So majorly, this is what we were talking about, the cash basis. The completed contract method, this method recognizes revenue when the contract is completed and all the conditions of the contract have been met. The percentage of completed method, this method recognizes revenue based on the percentage of work completed on a project. Installment method, and I think the percentage, they're almost similar, but this method recognizes revenue over a period of time, usually in equal installments. cost recovery method, this method recognizes revenue only when the cost of the project has been recovered. And this is majorly, this last one majorly relates to the overheads. You see, like in any institution, and from the example that we had from the previous presenter, you remember we had the indirect costs. And the indirect costs are a percentage of the other expenses incurred within the project. So unless you've incurred, then you are not entitled, you cannot be able to earn or to recognize the indirect costs. So the cost recovery method, this method, it recognizes revenue only when the cost of the project has been recovered. So once you are able to implement the activities, then you are entitled to earn that percentage of indirect costs or overhead rate as per what you had indicated in your budget when you were submitting your budget. Essentially, the choice of revenue recognition method, it depends on the nature of the contract and the company or the organization is accounting policies. And as I indicated, they're majorly or usually documented in the finance manual. So that is how we have the revenue recognition. So from this point, what we have understood or what is very critical is the issue of spending and accounting. So unless you spend and account, that one will not be recognized as revenue in our books. It might be still sitting as deferred income. And anytime maybe the funder comes and finds out like that accounting has not been done, then that money still belongs to them and they may request for that money to be refunded to their institutions. Sources of revenue, just to say, we have maybe different organizations, maybe, I just listed a few. We have the under NGOs category, we have the donations, we have grants, contracts of service, investment, income, endowment, funds, and all that. And the previous presenter, Duncan, indicated like, if you're able to review the contracts, you can be able to maybe put the funds you've received in the fixed deposit for a small period of time, and that can give you investment income. You can have other investments that you can do as an organization, as an institution, and it can bring in funds. And for the universities, we have the tuition fee, the school fees, the campus operations, training. Maybe you offer training to different teams or organizations. You can get donations. We have the government revenues, the exchequer. That's what is most commonly referred to. Maybe you have a team for the athletics or endowment fund. All these are sources of income that we can get for our different institutions. Revenue billing, that's the other area. We've finished on the revenue recognition. But before you get the revenue, before the funds come to your end, we have the other side of billing. What do we mean by billing? Billing is the process of issuing invoices and collecting payments from customers. And it is a crucial part of any business, ensuring that companies can cover costs and generate revenue. So what is this billing? You see, in organizations like APHRC, in our context, we issue our invoices to our funders, and these are based on the agreements that we have, which are the contracts that we have with our different funders. And in this, that's how we come up with the schedules, like we talk of the accounts receivables, and on the other hand, it goes hand in hand with the accounts payables, what we are owed and what we owe other people. And this process of issuing invoices, or in your context, maybe some of us, is the issuing of invoices and collecting the payment from our customers. This can be students, this can be the different areas that we've seen above. Maybe people need a venue and you will issue an invoice and bill them, and you'll be able to issue to them invoices. And this enables us as businesses, as organizations, to be able to cover all the costs and be able to generate revenue for us to be able to run the different operations of the organization. Billing is the cash flow that allows organizations or institutions to keep their doors open, like more of a going concern, and it includes all accounts receivables, which are the invoices sent out to the customers. And as I have said, from our end, the invoices or the contracts that we hold with our different funders, once we are aware, like maybe in the coming year, 2025, these are the this is the funding or the contract that we've signed with the different funders. That enables us to understand that in the coming year, we will be required to issue invoices, maybe at this point, depending on the schedule that we have. And looking at all the contracts that we've signed, all the income that we expect to receive in the coming year, then we know we will be able to cover. We have been able to cover the coming year 2025. We'll be able to run it as an organization. And as this statement says, it enables us to keep our doors open as an institution and to keep us going with our day-to-day operations. Because with the billing, it enables us to cover all the costs that we have as an organization. And also, this is how we generate our revenues for us to run the day-to-day operations of the organization. And it enables us to know, like, up to what point are we able still to cover costs, maybe in the next 2 years, in the next 3 years, depending on maybe the kind of, the number of students you have as an organization or as a university, as an institution. Then with that, you're able to project and bill, issue invoices to the students, and it gives you an idea of how you'll be able to run the institution as a whole. So while the revenue recognition is quite important, we have the billing also is quite important, because unless you bill your customers, unless you bill for the different services that you'll be offering as an institution, then you'll not be able to receive that income. So both the billing and the revenue recognition are quite important aspects of us to run an organization. Once these invoices are paid, the amount is converted to cash and used to pay for bills, employees, etc., any other costs that we need to cover as an organization. Value for money, I think that one has already been covered, so I will not go into it. We have the financial reporting. I'll just have a snip of it. A financial report, it summarizes your income and expenditure over a certain period. And for anyone to have an effective financial reporting, it requires the following. In the previous presentation, we remember we had, like, for us to be able to have proper tracking of our expenses, we need to have maybe a good financial system. We need to have a work plan. There are things that we need for us to be able to monitor our expenses. And once we've been able to monitor expenses, we are able to know this is what we have spent. And then we have the budget that was approved. Then it comes to a point where now you need a summary of the income you received and the expenses that you've incurred over a given period of time. And that is what is referred as the financial reporting. And with this, we need a good budget for you to be able to have a good financial report. You need to keep proper records. You need to have strong internal controls and proper and accurate financial reports. In this, I was to show a sample of an accounting. We know maybe you as our partners, you usually present to us a budget, and it's again that budget that we work with. And I have a very simple kind of budget, maybe that was shared from one of our partners. So in the budget, it will indicate the items on the budget. We have the budgeted amount, we have the actual amount spent, and we have the actual amount, maybe this is in the local currency, and then we have the actual amount spent in dollars, because most of the reports, we do our reports in dollar currency. And in this, what we usually ask is for you to be able to reduce our work and make it easier for us to be able to review the reports. We need to have the reports numbered, especially on the support documents. When we look at the support documents, when we look at this kind of report, we have the ethical review, we have the amount that was on the budget, we have the amount spent indicated, and also it shows the supporting document as receipt number 1. This enables the reviewer to be able to review the documents with ease and fast enough, and this makes the work easier from your end and from our end. And at the end of the day, you find like there is limited back and forth, even if it's the funders, not only to us as APHRC, but for any other funder you're doing the report for, in case they need support documents. It is very important for us to be able to have them referenced and indicated on the report. That makes the review quite fast, and if it's maybe another installment of funds that needs to be submitted to us, it makes the process quite fast. So whenever we are doing our reports, we request that once you have done the report against the approved budget that we had at the beginning, or when we entered into the contract or agreement, when you're reporting, you report against that approved budget and ensure the support documents are referenced to make the work of the reviewer easier and fast for you and for us also. When I say the referencing of the documents, we need, like maybe I've said, receipt number 1, it's here. This is, it should be indicated receipt number 1 on top of this receipt. Or if you have not indicated, then the name here, for example, this is an ethical clearance. And when you go to the report, you could see receipt number 1, it relates to the ethical approval. So if the documents are arranged as such, when I go to document number 1, and the receipt attached or the support document attached as number 1 relates to that accounting, it makes the review quite fast, and it enables us to complete the review and submit the report and receive the funds quite fast. All expenses must be supported by original receipts as proof of expenditure, and receipts of purchases made before the start and the end of the grant period will not be honored. I think this one we are aware. You can only report against expenses incurred within the contract period. Anything that is outside that period when you had not signed the grant or the contract, those expenses will always be disallowed. I had put here an sample of a financial report, but this one I think we discussed with Duncan. And this is just with like, maybe we have now the financial report to the funder. Assuming the first kind of report I've shown is what is coming from your end, then you share with me. This one might be a consolidated report, maybe from 5, 6, or 10 partners. We consolidate the report and then submit it to the funder. Also from our end, we will be able to report the financial report. It is in the form of the approved budget. We have the different activities indicated. Then we have the approved budget, the related expenses, the period it relates to, and we have the budget notes here. Here, there are no notes here, but we need to have the notes. For example, here, like in the previous question, we see maybe this person under travels, they have overspent on this budget line at 142%. There needs to be an explanation why that happened. Was there approval sought from the funder before, like we overspent on this budget line? So we need to have the notes also. If we have over expenditure, we have under expenditure. In addition to sharing our support documents, we still need to have notes to explain as to why we have overspent, we have underspent. And then when we have reported as such, when we have incurred our expenses and reported as such, then this, our revenue, we can recognize our revenue, it becomes valid. And now we can have this as revenue recognized in our books to be able to, because we've earned it and we have been able to do that which we were expected to do as per the contract signed by our different funders. I'll stop at that point for the revenue billing and reporting. And Anne, let me know whether I continue to GFGP or we have questions, or how do I proceed from here?
We can take about 5 minutes for pressing questions. So if you have any questions or no, Janet has presented, please raise your hand. Any question or Janet can proceed? Okay, Janet, I don't see any questions raised. You can put it in the chat as you proceed, so we can go to GFGP. Is it GFGP?
Yes.
Okay.
Thank you for that. And now we move to another area. Sorry, did I finish? I think there's a slide there of everything that I had already spoken. APHRC as the lead partner. We consolidate the reports. We have specific dates that we should submit financial reports to the funder. The reporting dates are also cascaded down to the partners. The partners need to adhere to the reporting dates. Accurate and timely financial reports is key in ensuring that funds are dispersed in time from the funder to enhance smooth implementation of activities. And the delays in non-reporting from both partners and APHRC leads to delays in funds disbursements from the funder, funding cuts, or even the discontinuation of a contract. In addition, it affects the credibility of an organization and hampers future funding from the funders. So that is just a summary of what I'd already indicated up there. Now we are going to another area. Maybe some of us have heard about it. Some of us, it might be a new concept, but some of us maybe from our institutions, this has been carried out. We are aware, we are not aware. It's something that from here, maybe today, you will go and find out from our institutions where we are, what else we need to do for us to be able to be in the map of the funders through this tool that we call the Good Financial Grant Practice. Just to give a small history, when we look at all the other areas, when we talk of project management over time, maybe they have good ways of tracking, they have good ways of reporting, maybe on their technical side of the reporting. When you talk of the grant side, over time or for a long period, they have also a way of managing the grants. We have tools that are in place for grants management. That's why we find maybe in all institutions, we have a way of carrying out our due diligence. And when we see under the due diligence, it is something that different funders come in. Maybe today's funder A comes in with their own rules and requirements, how they need the due diligence done. And maybe after a day or two, after a week, we'll get another funder coming in with their own requirements. And this prompted some institutions and through funding provided from different funders to come up with a tool that is more combined. It combines both the governance side, the human resource side, the contract management side, and the finance management side. So all this combined in one area and under one tool. And the beauty of this tool, once you've been able to carry out that kind of assessment or review or the due diligence, the other funders can be able to review. It's a portal, it's a tool. Once you've done the assessment, you've been certified, which we are going to understand what that means. Then the other funders can come in. The only thing they need is an access for them to view your assessment and see what you've done, what you have, how strong or weak your controls are, and it guides them and it enables them to know how much funding they can be able to provide to an institution. So that is just the introduction of what we have in the Good Financial Grant Practice. And with this, the GFGP development journey, this one, it started as with the stakeholders engagement, and which were coming from East, South, and West Africa, and meetings were held, and the discussions were premised on the international standards best practices. The components agreed at the meetings, and then we had the validation of the components by the funder community in Europe and North America. Then the second phase was the draft one developed by the consultants under the British Standards Institution. Then we had a technical subcommittee meeting, review of the draft by grants management experts from the grantor and grantee community. We have the technical harmonization committee. This one under the African Organization for Standardization. It was established, and the committee held 3 meetings, and we had a review of more than 3,000 comments on the GFGP standard, and the first draft of African standard finalized by balloting under the Africa Organization for Standardization African member countries. And in 2018, June 2018, the tool was launched, and it came out for us to be able to use. It's a tool, it's a Pan-African tool that was developed by Africans, but it is a tool that is meant to be used by the entire world. So this is the whole process that we went into developing of this tool, the GFGP tool. It's a very important tool, especially for the due diligence. It has the other benefits, but that is the journey that we underwent for us to be able to come up with this tool, which has a number of questions touching on the 5 areas that are indicated: the human resource, the governance, the finance, the contract management, and the procurement. All those are covered under this tool. The rationale for this tool: why do we vouch, or why do we need the GFGP? When we look at the rationale for the GFGP, I'm trying to remove this, it's blocking my view. When we look at the rationale for the GFGP, one, it's a common assessment platform. It reduces the administration time for both the grantors and the grantees, as one assessment certification covers the requirement of multiple clients. When we talk of this portal, this tool, GFGP, once you do the assessment once, as I've indicated, the other funders, they can be given access into this tool for them to view. And instead of you carrying out multiple reviews, multiple assessments, once you've done GFGP, then you do not need to do all the others. So what we are doing is just to get more funders come into this. They get a buy-in of this tool so that it can save our time as the grants people, as the finance people from our institution. Instead of carrying out the due diligence on every other day, once you do one assessment, then it's able to cover other multiple requirements that might be required by the different donors. It removes the need for multiple audits and financial assessments. Another reason is one size fits of all issues. GFGP allows consideration of organizations, and it has 4 different levels. The current version that we have, it has 4 different tiers or levels, which starts with bronze, silver, gold, and platinum. The assessment of compliance level for the different categories, it is in terms of percentage, and it provides clarity to the grantors on the relative amounts to extend to the organizations at different levels. With this GFGP tool, and when the funders come in to have a review, if they find that you are in bronze, they know like they can only give you maybe less than $50,000. When you are at the silver level, you can be given between 50 or it's 100,000 and less dollars. When we have at the gold level, if your institution is certified at the gold level, then you can receive 500,000 and below. And an institution that is at platinum, it can be given now more than $500,000. So it's a good tool that whenever a funder comes in, and maybe when they see, or you have a certificate that you can show and you say we are at bronze, so the funder is able to know for these institutions, according to the systems they have, according to the internal controls they have, we can be able to fund them to this level of amount. Same to silver, gold, and platinum. So it's a tool that already once the funder has understood it and is willing to go with the GFGP, it's able to guide them how much they can be able to fund the different institutions instead of coming again to carry out other kind of due diligences, other kind of assessments before they give you funding. It allows that, but it allows third-party review and certification. The GFGP, we have a pre-certification review and certification review. We have it in 2 forms. When we talk of the pre-certification review, this is whereby as an institution you are given the rights, or we call them credits, that's how we refer it in this system, is you are given rights and then you go in, you do assessment. You assess yourself. There are many questions which are in that portal. And so you answer the question. There are like more than 300 questions. So when you respond to the questions, as we said, there's a percentage of completion and compliance. when you complete, it's for each question that you've answered, so you are proceeding in terms of completion. But when we talk of compliance, this is now depending on the items or the document that you have, which have been requested for through the different questions that you will be responding to. Once maybe some of the questions are under finance, you'll be asked, do you do a budget? You say yes. Is there someone who reviews the budget? Yes. Maybe do you have a finance manual where all this process is documented? You say yes. If you have a finance manual, then and you answer all those questions, then it means you are complying. So it's adding your percentage. If you say yes and you do not have a document, then it means you are not complying at that level or for that question. And the beauty with this GFTP, it relies majorly on documentation. Documentation in that if I'm not in today, if I leave the organization today, I could have had all the processes and procedures documented. So whoever who comes in after me, they're able to carry on with the operations of the institution without getting challenges. So one of the best advantages that we have in this is the issue of documentation. And that's why when we talk of compliance, most of the questions, they will request you to attach documents. And you can only attach documents and policies and procedures once you've been able to document them. So when we talk of allows third-party review and certification, once you've been able to do the assessment by yourself, you have completed all the questions that falls under the pre-certification. Then we have auditors. We have auditors who have been selected. We have a few chosen auditors who can be able to come in and do a review of the assessment that you've done. You know, the system cannot be able to identify or understand. Maybe when I said I have a finance manual and I attach something else, the system is not able to identify or know that I've attached the wrong document. So what happens now? We have the auditors who come in to review and certify that the kind of documents I've attached, the relevant documents, I've answered all the questions correctly. And at this point, then they will be able to issue certificates. We have certification review done by a scheme of qualified auditors, audit firms. And after that, they issue a certificate that is valid for 2 or 3 years. If you are at bronze and silver, you are given a certificate valid for 2 years. And if it's gold and platinum, the certificate is valid for 3 years. And why do we do this? You know, as human beings, if you are given a certificate, a lifetime kind of certificate, then it means you may go out and relax. Maybe your finance manual needs to be reviewed maybe after 2 or 3 years. Now, because you have the certificate and you know you've been reviewed, maybe the funders are okay with the kind of review they have received, then you may go out and relax. You may not update your policies and your documents. So like any other place, so even with the certification we receive as institutions, maybe for ISO and all that, after 2 or 3 years, the auditors.
Yes, time, please take the next 3 to 5 minutes to wrap up. Thank you.
So we have the after 2 or 3 years, the auditors come back to be able to recertify your organization or your institution for you to be able to be sure like you are still maintaining the best practices within the industry. You are still having the right documents in place, and the funders can still have the same kind of confidence in your institution as they have had before. Also, it raises the credibility of even the smallest grantee organizations onto a global stage. You know, once you have been certified by a third party at bronze, silver, gold, or platinum, anyone else who wants to view or review your processes, they're able to do that. And even if it's a small organization and you've been able to go through GFTP, then your visibility and your credibility is at higher level. Then it's a great tool for capacity building. And with this, once you are doing the assessment, you will be able to realize the areas that you do not have documents, areas that you need to maybe you are lacking documents, areas that you are not doing well. And because of the questions, the kind of questions you'll be asked to go through, it will enable you to know the gaps that you have as an institution And then you will be given time to be able to build on these areas, come up with the documents required, and be able to now become compliant with the GFGP tool. And with this, even the funders, for those who have had a buy-in, they are able to fund you to be able to cover for these gaps. And even APHRC for the projects that we've worked with and the ones that we have received funds for, we have partnered to ensure that we have assisted in the capacity building for the different partner institutions. So with that, I know we've said the GFGP, it's financial management, procurement, and human resources and governance. These are the major areas it covers, and it's cumulative as you move from one area to the rest. So maybe to just give a snip is to say what the different levels stand for. For bronze, we have bronze, silver, gold, and platinum. Under bronze is just procedures, like the procedures on how you do something on a daily basis. That is an institution that is able to demonstrate that. Those are the ones that can go for the bronze level. We have the silver level. Do you have processes? Have you documented your procedures, the day-to-day activities that you do? Under gold, we talk of policies now. Institutions should have the finance manual, they should have a procurement manual and all that. So if you're in that level, then you go for the gold status or the gold certification. And for platinum, we talk of the best practices in the industry. And the best practices of the industry, it depends on the industry you are in. If you are at a university and institution, you have the best practices, how the students are supervised, how do you manage maybe the resources within that institution, within that industry. So if platinum, for you to be in that level, then you must be having the best practices in your industry. If it's a research organization like APHRC, then you have the best practices within that research area. And with that, maybe you have a disaster recovery policy, you have disaster recovery, you have an investment policy as an organization and all that. All that will fall under the platinum level. You have the finance committee and the audit committee separated. Generally, under platinum, you must be the best. You are doing the best in the industry that you're operating in. Given that our time is up, just wanted to say we could have gone through the different, to just give an example of the different tiers under the bronze. Maybe we could go through each of them. The pillars, which is the internal controls, record keeping, planning, and monitoring. Those are the pillars that GFGP builds on. So it shows from one tier to the rest, from bronze, silver, gold, and platinum, what it covers. But we will plan maybe to have more time to go through this. Generally to say, APHRC, we have had funders who have already come in. They have had a buy-in into this GFGP. We have the CARTA program from those coming from CARTA and funded by CEDA, Science Foundation for Africa, Carnegie and NORAD. We have CEDA, we have Gates, and these are funders who have already had a buy-in for GFGP. So if as institutions we go in, we have these funders and more who are getting a buy-in into this for us to be able to improve the way we operate through the GFGP tool. Lastly, as APHRC, we always say that we walk the talk. We underwent the process, the self-assessment, and we received a certification in June 2022 under the platinum level. So it will be expiring in June 2025 for us to get, again, for the auditors to come and review our processes and procedures. And for us maybe to get a renewed certificate for the next 3 years again. As we have indicated, for us, we've already gone through this. We have funders who have had a buy-in, and we are calling upon all of us to join in into this GFGP, for it will save our time. And with the rationale we've given, we will be able to be maybe on the global stage. Thank you, Anne. Over from me and back to you.
Thank you, Janet. Thank you for that informative presentation. And yes, we'll be sharing the presentation and the resources, so you'll be able to look at what Janet has quickly gone through towards the end. Do we have any questions? I think most of the questions in the chat from the previous session have been addressed. But do we have any comments the participants would want to raise on GFGP or revenue recognition, billing, and reporting, please feel free to unmute. We want to hear your thoughts and experiences you've had with both of the areas, or the comments that you may have for Janet. We have about 10 minutes for an interactive discussion on this, so feel free.
Yes, I'm Peter Tem. I want to know on the issue of over or under, what percentage of the variation need explanation from the previous presentation?
That is to Duncan. I don't know whether Duncan addressed that in the chat. I thought he had.
Just in the chat.
No, not Duncan. I think it was Janet.
Okay. Different funders have different rules and regulations on how much you can vary, but majorly, most of the funders it's at 10%. Very few of them have it at 20%, but most that we've interacted with is at 10%. Anything beyond the 10% you need to request for authorization from the funder.
Okay, thank you, Janet.
Thank you.
Anyone else? Please feel free to unmute. Janet, I think your presentation is very straightforward and everyone is happy with the information you've gotten. If there's no other comment, probably we can move to the next session, but I encourage you, if anything pops up, yeah, the presentation is okay. If anything pops up, please feel free to put it in the chat. Janet will address as we proceed. And now we can move to Kevin's. Thank you, Janet.
Thank you, Anne.
Thank you, Anne, for the great moderation. And I will take a very few time to just go through this session so that we can wrap up with the discussion. However, I would still encourage people to register. I think there are people who are experiencing some problem with the registration form. Joy, please sort them out if you can. That would be good. Then I will make a short presentation, and then within the presentation there are discussions. So we will not have a discussion after, unless there is a question that would be raised. Then after that, we're going to have more of the final discussion that there is. Thank you very much. Let me make this presentation. Where is it? Share screen. Here. Can my screen be seen? Can you see my screen?
Yes, we can, but not on presenter mode yet. Yes, no, it's fine.
Now?
Yes.
Good, thank you very much. We're going to have a very short talk on associated risks in terms of financial accounting and financial reporting. I have tried to classify them in those two areas. We're going to look at them as they are. One of the things that Janet mentioned when she started training was the issue that has come up even with our audit about reporting that coming from our partners. And this has become an area of concern to us because of what it means. And some of those critical concerns of what it means is what we want to address in this presentation. So we're going to just make a very short brief of what risk is, and then we're going to look at the financial accounting risk themselves, and then we're going to look at financial reporting risk themselves, and in between we are going to discuss both impact and mitigation measures. So risk is basically uncertain event, something that you don't expect, something that it has a possibility of happening. And so there is no guarantee that it is going to happen, yet we need to prepare for it because it has effect on the outcome of a project. So with that kind of an understanding, then we allow ourselves time and resources to make sure that we are able to look at them and be able to deal with them, because when they happen, then it causes us a lot of trouble. Then the scope of financial risk is from it starts all the way from budgeting to actual final reporting. So in between there is quite a lot of the issues that can happen that would go wrong, that would affect the implementation of a project in as far as finances and reporting is concerned. So basically, in any project management, there are three constraints that we consider. And all of them, they pose certain risks and they have a bearing on the accounting and financial reporting. The first one is time. How do we schedule for a project? What is the start time? What is the completion time? And how does that one affect costing? When you schedule a long time and you're paying staff for that project, and the project could have ideally been done in like 6 months, then you have that has an effect, has a ripple effect on the financing in terms of staff. If you schedule it too short a time, and then you have a lot of work concentrated together, there is a possibility that it will cost you more because you're doing that cost at a high rate. The scope, project tasks required to be fulfilled within the project goals. So this is basically, how do we achieve the goals of the project? Are we achieving them effectively, or are we achieving them efficiently? Those two elements need to be considered. When you achieve it efficiently, it means you're considering quality, you're considering time, you're considering cost. If you achieve them effectively, it means that it doesn't matter the cost, it doesn't matter the time, all that you care is achieving your goals, and that becomes a problem. Then the costs, I don't need to go through that because it is basically now what we consider, what is making us talk today. The cost of a project comes in as a constraint in terms of project management. Now, when you talk about financial accounting risk, basically, I don't have to repeat this because you're looking at what Janet has already indicated and Duncan has indicated. But what are the common risks that are there? There is the budgeting risk, basically caused by lack of historical data for estimating. You estimate right because you have historical data which you're relying on, or you estimate wrong because you don't have the right data to have. You can have unrealistic assumptions. Sometimes inflation comes in, and there is also a risk in terms of that. And there is always need for us as we work through project then to be able to say, how do we capture this? How do we make sure that this are mitigated on? And we are going to look at mitigation measures later. That will be a discussion for all of us. The impact of this risk is basically increased financial strain. there is also kind of, it can cause scope reduction. It can also cause project delays because, again, if you had budgeted for this amount of money, your assumptions were wrong, you didn't have the right historical data, what could happen is that you find yourself under costing, which means then the scope of the project must be reduced for you to be able to achieve what you needed to achieve. The cash flow risks, this one you all know, causes a lot of delays, payments, poorly planned disbursement also coming. One of the things that affected us this year is delayed disbursement, because not because of cash flow, but it was because of reporting, which brought in a problem. There's some projects couldn't carry out some activities as scheduled because of that. But it can also be caused by cash flow, and you are expert in that area. And impact of that include project slowdowns. You could have strained relationship, especially with your suppliers, where you have asked them to supply things and then you're not able to pay on time and according to contract. That becomes a problem. Then we have data integrity risk. This is basically inaccurate or incomplete financial data, basically caused by errors in data entry, weak financial softwares, or lack of integration of your software to the greater accounting system of the institution. Then you find yourself, you have data that is not correct, and that's a big risk. And the impact of that is basically faulty financial reporting and misaligned decisions, because you made decisions based on evidence that is derived from wrong data, and therefore you have a problem in terms of not having a decision that is right. And then the reports that you have will have problems. Many of the reports sometimes you may put out there and you hear us or other people are asking for more clarity. It could be just because of some entry that were not right. There is also compliance risk. This is caused by inadequate internal controls, and Janet talked about that. Lack of understanding of the regulatory requirements that are there. Sometimes, not that you don't understand them, but sometimes you don't keep updated on the requirements that are there. And sometimes we find that donors are using different requirements than what your institution is using, and then you have to calibrate yourself, your report in that manner, which also becomes a strain to you. So you must be updated on that, the impact of that, possible legal penalties, fines, the reputational damage, especially with donors, where you they feel like you are not competent to handle what needed to be handled. Then there is the frowned risk. This is always a risk in terms of accounting, basically where we have misappropriations of fund or manipulation of financial records to be able to suit the accounting, to account for all the amount, or do that, you find yourself cooking data, which is wrong. Then the impact of that is financial losses, possible legal consequences, loss of stakeholder trust, and that is extremely important. When you lose the trust of your stakeholder, of your donors, then you have a problem with getting more funding coming your way. So you lose funding, you lose partnership, you lose key people in your system. There is what we call scope creep risk. This is basically uncontrolled changes to project scope, basically the activities. Basically, you can think of increasing the financial burden because the activities have either increased because the scope has widened, or at some time you have more activities than you had budgeted for. Therefore, you have a problem with that. That's a risk. The impact of that is we normally could have budget overruns, and misallocation of resources can also come. And with all this and others that you may know, what would you think are some of the mitigation measures that could be there? I will stop sharing actually. and then we have a discussion on some of the mitigation measures, and then we can come back again to continue with our sharing. And I would wish to have people shoot their hands and think of these mitigation measures of some of the risk we've talked about. We've talked about budget risk, cash flow risk, data entry risks. We've talked about compliance risk, fraud risk, scope creep risks. What are some of the mitigation measures that you think we could employ to get to make sure that we don't find ourselves in such situations? Is there any of this that has ever happened to you, and how have you solved it yourself? You can also have that. Anyone? Any taker? Are we in the house? Yes, there is one in the chat. For budget risk, one can be achieved through budgetary control enhancement. Thank you, Pierre, for that. Budget control enhancement. Any other person? You can still put it on the chat if you don't want to speak. That would be okay. I'll see it. Are these risks real in your places, in your institutions, or you don't have these risks, or you have not looked into them and see risk at some point? What are some of the risks that you are experiencing? Maybe I have not captured them. Yeah. Yes, Akim, please.
Okay, thank you for the presentation. Firstly, on the budget risk, one should try as much as possible to make the budget a robust budget, a budget that will be able to capture effectively the proposed expenditure and also the expected income, at least the various areas of the project, a budget that will be able to capture it in a robust manner. And also on the risk associated with fraud and some of these irregularities, a good internal control system to be put in place in that organization. So internal check and internal control system to be put in place so as to mitigate this risk to the barest minimum. And not only that, to sanction and then the reward system too. So we should also have it in our organization. A human being, just like that theory of management, theory X and Y. The moment people know that there is no any rule, there is no any sanction, they can do it. But if they know that if they are involved in any irregularities, they are going to be sanctioned. That one too is also a moral check on the staff of that organization. Thank you.
Thank you. Thank you, Akim. Charles?
Thank you very much. Most of the risks outlined here can be mitigated by sticking to the contract with your partners. Because with that one, it will give you the guide on which things to spend and which one not to spend. So the first thing is to be in alignment with the contract. And also, there is a need to have a regular various analysis. By various analysis, what I mean is to compare your actual spending against the budgeted. And whenever there's any deviation from that, there's a need to put controls. With that, I think we can be in the right direction. Thank you.
Kevin, are you with us? think he's having a bit of internet issues. Yes, Haji?
I hope you heard me. Thank you.
All right.
Yes, I did. We did. Thank you. Yes, Haji?
Oh, okay. So I'm thinking whether this fits in the context of what we are discussing. But in the event where, for example, you have like a turnover, maybe you are working with a particular person, a staff, and then maybe the issue of the output or capacity issue, or for some other reason the person is leaving the role that they are playing. What are the interval that it will take you to have another person fill in such area, and whether that lasts will not also be a risk to the implementation or the activities you are carrying. And if that happens, the time it will take you to have another person, whether recruiter or the onboarding process, how long that takes could be part of the risk issue. If that is feasible, in my view, I don't know. Thank you.
I should think so, but let's give Kavins a few minutes. Sort of like business continuity. Okay. I see we have something in the chat. Compliance risk can be mitigated by respecting financial reporting deadlines, respecting procurement process, and grant agreements, terms of agreements. True, fraud risk can be mitigated through proper hierarchical authorization process and through regular reconciliation of transactions. Yes. Anyone else as you wait for Kavins? I'm just admitting him. A few minutes. Kavins, are you back with us? Yes.
Oh, I didn't hear your question.
No. Kavins, he's just coming. Yeah,
Okay.
he's back. Yeah.
Sorry, I think I got lost. The internet went on me. But Han?
No problem. We have some comments in the chat. But Haji has just spoken when you were away, and he was talking about the gap that is left when one person leaves. I don't know whether he would want to repeat his input quickly.
Yeah, sure. You got me well. So I was saying, should a gap be caused by someone's absence, either due to capacity issue or due to something different, that when one is leaving and the void is there, that obviously it might not be the risk in the context of what you're saying, but I'm saying it also has its own implication on the team. So I know having another person hire or recruiter to be on board there would be the way to mitigate it. But then first of all, I want to know if it applies to the context of what we are discussing.
It definitely does
because
apply.
you don't.
It definitely apply because again, when you realize the project personnel does that, and the best way to deal with it is to make sure that there is no basically very good handover from the person who was doing the previous reporting to the current person who is doing what you're doing, and inform the organization like it's overseeing that accounting. For example, it's APHRC, inform APHRC about this particular person leaving and this one is joining, so that this particular person is able to be linked with what was happening and have the historical memory to be able to patch you up with what is happening with the new person. That would be a very good practice to be able to follow. And I can see also a comment on the fraud risk, tighten the internal controls, segregation of duties, various persons to avoid a requisition and payment being done by the same person. That's a very good way of dealing with that kind of fraud risks. Allow me to continue sharing my screen so that we move a bit faster with this one. And thank you again for that. Okay, are we on presentation mode? Yes, there we go. So we've gone through this. So the other one is now financial reporting. Basically, when we're talking about reporting, we were looking at providing information to stakeholders so that they can be able to understand how your project is performing, how your compliance is, and this kind of report is going to be able to give them information to make decisions that need to be accurate, that need to be reliable. And this financial reporting is very important for us to track the expenses that are happening at various levels of the project, and even be able to make sure that we don't lose anything. Some of the risks that are associated with reporting includes accuracy risks. And basically, this is caused by data entry errors and things like those. You are also having misclassifications of expenses or revenue, and Janet handled that a bit. You can also have inadequate reconciliation processes that causes some errors, and therefore you have that kind of risk. The impact of this is basically misleading financial reports. And again, it affects the decision making as we know them. Then there is also timeliness risk. You realize in our world where we live in, we have some time limits that are associated with the contracts that you signed with the donors in terms of when are you reporting. And I know Charles talked about aligning our practices with the contract, which is a good one. But you also realize that we are operating in systems that are governed by other processes. For example, a government institution and government takes their own date, not at the end of the year, but at the end of the government accounting year, which is different from what donors may be requiring of you to do. So what do you do? How do you deal with such? So timeliness, again, is an issue, cost because of inadequate processes. Is it possible that we don't provide a process for such requirement when it is given? A requirement that that requires you to account maybe in end of January, by end of January, yet your audits are scheduled for June, July. How do you deal with that? What processes have you put in place to be able to deal with such incidences? Insufficient workflows also come there, communication breakdown also. The impact of this is missing deadlines for regulatory filing, stakeholders updates leading to loss of stakeholders' confidence, because again, most donors, you see them tying this reporting to maybe next disbursement and things like that. There is compliance risk here. Again, I will not go back to that because it is common. Then we have data security risks. Now, this includes issues of breaches from inside the system, and this can cause a lot of problems in our accounting, in our reporting. And the impact of this basically is when you have data leaks, financial losses, or data leaks, violation of data protection laws. I've repeated myself there. Sometimes when this happens, you find ourselves into some precarious situations where maybe even we are finding ourselves being prosecuted for data usage, data leakage that is not authorized. Then there is lack of transparency as a risk. This is basically caused by omission or deliberate misinterpretation of key financial information. And when you do this, basically it has a lot of impact in terms of trust and getting lost, and might cause you to get some visitors who are coming to investigate what is happening around you. And this happens a lot. You have donors who come to do another audit, even after you have done another audit, because there are issues that could not be explained. Some of these issues may be caused because of just some misalignment of processes from what institution is doing, from what is expected by the donor, and then it is sometimes construed to mean that you are not transparent, but in actual sense, it's systems that are not aligning. So it's very important for us to make sure that we have the same, we are speaking from the same note. Then the overdependency on technology. It is good to have technology. It's good to have softwares dealing with this, but you also understand that systems can fail. Sometimes if we don't even update the system, some of the data that they produce is not up to date, or it's not in a manner that would be very good in terms of how the donors want their data presented. And for that reason, we might have to look at ourselves as not being competent in what we do. So you have systems, it's good, but please make sure that the systems are updated and they are calibrated to make sure to capture the right information and in a manner that is actually expected to be expected by the donors. Impact of this is delays or inaccuracies in terms of reports, and this again can cause a lot of operational risks. Now, again to mitigation, and this I'm going to deal with it as it is the last of the slides. So allow me to ask ourselves what are some of these. And by the way, I have documented some of those mitigation measures that we are looking at, and we can refer to them back when we come to the end of this presentation. However, I would ask for someone to just shout. I will not stop the presentation. Let me see whether I can see someone just unmute and shout, or hand, if you can see, please point out. Anyone
Hello?
who wants? Hello, go ahead.
Okay.
Go ahead, proceed. Who was talking? Anyone else? Maybe these mitigations were very clear, but some of those mitigations that we're looking at in terms of this risk is sometimes to implement automated tools for data entry. This will reduce a lot of errors in terms of accuracy. In timeliness, please establish clear guidelines, clear workflows, design tools that are compliant to monitor progress. In terms of compliance, regularly review and take updates or knowledge of the reporting standards, conduct periodic internal and external audits. It's very important. In terms of data security, have strong access control and encryptions. Conduct regular security assessment, including cyber checks, whether you can be hacked, and in that case, can someone hack you and alter data from your system. Lack of transparency, install a culture of accountability. and ethical behavior and have independent reviews of financial reports even before you send them, so that you can have them checked through. Then over-reliance on technology, it's you regularly please update and maintain the financial systems and develop contingency plan in case the system fails, so that you can be able to see that you are not delayed in what you do. Now, these are some of our funders that we know, and that would come to an end of that presentation. At this point, I would ask for any question that you may have. If there is no question, then we would move to the next session. I can see Akim hand is up.
Okay. Thank you for the presentation, Kevin. My question is on this risk management. Actually, some of us are involved in developing risk management policy for our institution. Like in UI, we are in the process of developing a risk management policy. Can you please share a template that we can adopt for this purpose? So we have been on this for some time. A committee has been set up, but I'm wondering if we can have a template that can be adopted in developing a risk management for University of Ibadan. Thank you.
Thank you, Akim. And I would want more clarity from you. Are you looking at development of a policy, or are you looking at an assessment framework? Because those are two different things. Because policy will just talk about not necessarily identify the risk, but now give a process in which risks are identified and mitigated on. That's a policy. But if it's a framework for documenting and managing risk, that's a different thing.
Actually, the two will be okay. But the reason for the policy is that most of our funders, one of the things they used to ask, even in our GFDP certification process too, one of the things they usually ask for is risk management policy. But it also assists the institution too, if you also have a framework too. But if I can have the two, I will be glad, sir. Thank you so much.
Thank you. In most cases, you find the policy and the framework template in the same place. So yeah, we can work on that. Please remind me at some point later.
Thank you.
Okay. Any other? All right, I'll return this meeting to Han so that we can move to the last bit. Thank you. Han, you're muted if you're talking.
Yeah, thank you, Kevin. We are now at the tail end. Great presentations from Kevin, Duncan, and Janet. And for the questions, please keep them coming. And we are supposed to end up at 2. So the next 10 minutes, Duncan is going to do the closing remarks and sort of a summary of what the conversations we've indulged in the last 3 hours. Time goes by very fast. Duncan, over to you. Akim, is this a new question? It's a legacy hand. I think it's a legacy hand. Okay, Duncan?
Sorry, it's an old done. Sorry, it's an old done.
Okay.
Yeah, mine is to first appreciate all for participating, but I don't want to close before hearing whether we have any pending question, clarification. And before we go there, I have 2 comments to make. One is about what Janet shared concerning the FGP. I take it as a high time for all of us. When Janet was presenting, she indicated that APHRC is already certified at their level of platinum. And mine is to call upon all of you to consider the same, because this is a tool that's being aggressively being recommended to the donors, and quite a number of donors are getting on board. And it would be disappointing for any one of us if we end up later on like not getting funding because that becomes like a requirement by that particular donor. The pros are quite significant for the donor in that they don't have to do their own assessment. Janet went on to just indicate the kind of advantages with it. So position yourself in a way that you are not left behind. For APHRC, we could have assessed a severed gold because that's what you are qualified for when this tool came. But what we did, we decided to work on, after self-assessment, work on items that we felt would take us to a platinum. When the audit was done, a few items still we were not qualified, and the auditor said they would give us several months, I think about 6 months, and come back and audit again. And that's when we got the platinum certification because we worked hard. And some of these things are not easy. Like some of them may require that you seek council approval or the board approval. So it's not something you can say that we'll do it then maybe next month we'll have it in place. So my simple comment is, can we look at it and see what needs to be done and begin preparing ourselves. Then the other thing is on the risk. It's always my comment to my team that they need to look at things with a risk eye. If you make this your practice, you'll find audit queries will go down. Your due diligences will be okay. Your financial reporting and all that will improve, because what it does, it makes you do the right thing at the first time, so that you don't have to like go back to amend. Maybe this process was overlooked. Yeah, but when you look at things with this risk eye, what could go wrong? What potential issues may be raised from, say, a transaction, an event, an action, yeah, and preparing for it. Over. Those are the two things I wanted to say. Then let me open for any other comment that anyone of us has before we conclude. Again, this is a beginning of many other opportunities. When I was presenting the part of project, the expenditure monitoring, I spoke about budgeting as what we was calling activity-based budgeting. There's a training around budgeting. I think in the future we'll see how to incorporate that and other capacity building opportunities that may arise. Yeah, so I'm looking forward to even greater engagement into the future. Charles has said the training is very important platform to enhance our capacity strengthening and instill financial discipline within our platform partnership. I'm pleased to organize a physical meeting next time. Kavins, you've seen that comment.
Yes, I have seen it. I have seen it. Thank you.
Your budget allowing and your proposals in the future can consider that. Any other comment or question? Thanks, Charles, for that. I think Charles will be glad to host us in Malawi.
Yes, I will be very glad.
Seems like there are no other comments. So I think you have 10 minutes to go. Yeah, mine is if there are no other comments, I don't want to lock anybody out. It's to thanks the team led by Kavins and Anne for organizing this. And yeah, looking forward to meeting all of you some other time. Bye-bye.